Hello, Prem. So, students, we'll start with this particular session. So, it will be a marathon session today for this particular area. So, we will be completing this particular context. We shall be completing this one. And secondly, students, we should also be completing this particular once this has been completed, thereafter, students, assessment procedure also will begin. Okay, so shall we start now, students, in this context? Just allow me a minute. Students, before that, today, students, is the last day of the Unacademy subscription. As you can all see. So today being the last day, students, for the Unacademy subscription plan. Therefore, you are requested that any of your friends, colleagues, juniors who may be doing CA Foundation, CA Intermediate, or for that matter even CA Final, so do recommend to them about this particular batch which is there, so that they will be in a position to take up the benefit from the same. So that is one thing, that they will be in a position thereafter to take the benefit of this particular batch which is there in this context. Okay, so just they need to do one thing, students, is that they need to put across the referral code, and the referral code, students, that they're going to put up would be CADS. So it is the referral code CADS that they need to put up for the purpose of getting the benefit of this particular 20% off on the CA subscription which is being there. Fine, students. So today, again I'm repeating, students, today being the last day, and thereafter, if you may be aware that there is a batches which span across for November 22 attempt, May 23 attempt, November 23 attempt, May 24 attempt. All the batches are there. So definitely, students, they will be in a position to avail any of the batch of their choice. Fine, students. So with that, students, let's start with our today's session. In this context, now, student, this was a particular question which you can see, which we will be doing it now. This is about the previous question. Sorry, question number 473 pe. So question number 473 is what was being there. Sorry, 463. 463, students. Fine. So I will do one particular question over here, and later on, students, one question of this cost plus method will be a homework, so you will be doing at your end. So let me do one particular question in this context. Now, the cost plus method, students, if you all will see in this regard, what exactly it is. In respect of the cost plus method, students, what happens is that you will find over here that the entire aspect of this particular method revolves around on that the steps that has to be considered is that first you need to add the total cost. So the total cost, primarily, students, is what you need to determine of the international transaction. So of the international transaction, students, you need to determine the total cost. Okay, that is the first and the foremost thing that you will do. Once you have determined the total cost of the international transaction, thereafter on that particular total cost, you will then add up what, students? Add up the markup percentage. On that particular total cost, you will then add up what, students? The markup percentage. Now the markup percentage, students, is obviously you'll take up the comparable markup. You will be taking up what, students? The comparable markup, isn't it? So the comparable markup is what will be taken in this context. Comparable markup is what will be taken in this context. And then thereafter, students, in this context, once you all take up the comparable markup, then thereafter, students, as you can see in this context, you will do the adjustment of the uncommon factor, students. Adjustment of the uncommon factor on the comparable markup percentage, students. Adjustment of the uncommon factor in the comparable markup percentage. This is what, students, you need to do it in this regard. This is what you need to do it in this regard. So students, in this particular context, you will be doing in this regard the comparable markup percentage, and that comparable markup percentage has to be adjusted with the uncommon factor in such a way that the markup that is determined after the adjustment, the markup which is determined after the adjustment aligns to the factors which are there in the A transaction. Aligns to the factors which are there in the A transaction, students. Is that clear to all of you, students, now? Fine. So this is precisely what needs to be done in this context. So students, this is how the things has to be looked upon. Now, please go through this question once and then we'll start with this particular discussion. All of you, students, quickly. Question 463. Just do a first reading. So students, let's have a look then. Nano and C dot. So you could see here both of them are associated enterprise, Nano and the high tech, isn't it? Now Nano is supplying, students. So Nano supplying, high tech, which is the Indian company, it is providing the software development and maintenance service to the customer across the globe. They are the one who are providing what, students? The software development and maintenance service to the customers across the globe, students, which includes even Nano. So therefore, if you see, always, students, I told you one thing, and just keep this point in mind, that whenever you do this, always the international transaction which is given in the question, always visualize that this international transaction gives the impact on the profit and loss account of the Indian AE, either in the profit and loss account debit side or on the profit and loss account credit side. Where the impact is given, students, is the impact is given in the P&L debit or in the P&L credit. That is one thing that you should be clear about it, students. Where the impact is given, whether the impact is given on the profit and loss account debit or on the profit and loss account credit side. Is that clear to all of you, students? So this is the first and the foremost thing that you should always keep in mind in this regard. Okay, so therefore, if you see over here, for the Indian AE which is high tech, the impact which is given, the impact which is considered is on the profit and loss account. Which profit and loss account? Profit and loss account, indeed. Profit and loss account, students, credit side, because we are the supplier, isn't it? So it is in the profit and loss account credit side, students. Perfect. Now, after this, if you can see, Prem, so what the situation is, that they have provided, students, 2,400 man hours, which has been given to you. 2,400 man hours, students, for developing and maintaining the software for Nano INC dot, with each hour being billed at rupees 1,300. Each hour, students, is billed at rupees 1,300. That is fine. So that will help us to know the transfer price. So this actually is the transfer price, 1,300 per man hour. But what we require right now is the cost what has been incurred in this international transaction, and the cost which is incurred in the international transaction is rupees 20 lakhs. This is what will be picked up, students. This is what will be picked up in this context. So therefore, students, this is what it will be picked up in this scenario, students. Isn't it? Now with that, let's come to this particular part in this context. So now have a look, students, over here. Next paragraph, students. So in this scenario, if you all will see very carefully, what is that you will get it? High tech has also, now they are giving the information about the comparable, students. Now the information about the comparable has been given to you, and what they are suggesting over here, the comparable information. In this context, High Tech Limited has also undertaken developing the software for Modi Industries, for which High Tech Limited had billed at rupees 2,700 per man hour. So this is the comparable price. This is the comparable price, students. Now the persons working for Modi Industries and Nano INC dot were part of the same team and were of matching credentials and caliber. This information just is to suggest to you that they are the comparable transaction. This information is simply to suggest that they are the comparable transaction, isn't it? So now, students, High Tech Limited has made a gross profit of 60% on Modi Industries work. So this 60% is what, students, you are going to pick it up. This 60%, students, is what you are going to pick up in this case, isn't it, students? So that exactly is the point. So you will pick up the 60%, and this 60%, which is the comparable margin, will be adjusted with the uncommon factor in such a way that after the adjustment, whatever is the adjusted margin will align to the factors, which is there in the international transaction. That is a transaction with the AE, isn't it? So let's have a look further what they have to say over here. So High Tech Limited transaction, students. High Tech Limited transaction with Nano INC dot are comparable to the transaction with Modi Industries, subject to the following differences. Now, what is the difference in this context, students? You can see over here. So Nano Inc. dot gives technical know-how support to High-Tech Limited, which can be valued at 8% of the normal gross profit. Modi Industries does not provide any such support. Please be careful. From my associated enterprise, non-resident A, I am getting a technical support. Okay, now you tell me, students, thereafter, if I am getting a technical support, thereafter I have to charge to that particular non-resident A. You have to tell me that when I am getting a technical support and thereafter I have to charge to that particular A, thereafter I have to charge to that particular A, students. You people have to tell me this. What is that? Whether, be careful now, students, whether in this particular case, students, whether in this particular case, am I going to charge my non-resident A higher selling price or a lower selling price? That is the first question. Am I going to charge to my non-resident A higher selling price or a lower selling price, students? What is your take on that? Will I be charging them more or will I be charging them less? And indeed, I will charging them low amount because I'm getting a technical support. Then if I'm getting a technical support, I will be charging them a lower amount, and that exactly is the point, students. So in that particular case, I will be charging them a lower amount, and by virtue of which will my margin in the A transaction would be lower. If my sale price is less, then my margin in that A transaction also would be lower. And that is the reason why, students, what I need to do, this 60% which has been given to us, I need to reduce, students, the 60% which has been given to us, I need to reduce primarily with this particular factor in the A transaction, with this particular factor with the A transaction. And how much reduction? Now see how intelligently these people have drafted the sentence. They are saying that it is 8% of the normal gross profit. 8% of the normal gross profit, students. And with the 8% of the normal gross profit, so your normal gross profit is 860. So 8% of that becomes how much, students? 4.8%. So 4.8% is what would be reduced in this particular case. I hope that all of you are clear with this one. Every one of you. Now let's come to the second particular part, which is point number 2. And what does it say? Since the work for Nano Inc. dot involved huge number of man hours. So this involved what? Huge number of man hours. A quantity discount of 14% of normal gross profit was given. Students, a huge number of man hours is there. So therefore a quantity discount of 14% of the normal gross profit was given, students. So in that particular case, students, you tell me, I am giving to my A a quantity discount. If I am giving to my A a quantity discount, the price will be lesser. The price charged would be a lower amount. And if the price charged would be the lower amount, the profit in that case also would be a lower amount. Do you all agree to this one? If the price charged, students, is a lower amount, then the profit also would be on the lower side. Do you all agree to this or not, students? All of you. So therefore, in this particular context, what the situation would be, so this is how it has to be considered. So over here, students, which has been given to us, and what they are saying in this case, that since the work for Nano Inc. dot involved huge number of man hours, a quantity discount of 14% of the normal gross profit was given. So therefore, in this case, I will be reducing the comparable margin with this particular factor, which has resulted into a lower margin in the A transaction. So even the comparable margin needs to be reduced. and therefore in that case with 60% we will have this 14%. So I will reduce from 60 14% of the normal gross profit. How much is that 14% of 60 in this context, students? Whatever it be. So that much percentage, students, will be reduced in this case. Coming to the third particular point, students, High-Tech Limited had offered 90 days of credit to Nano Inc. The cost of which measured at 2% of the normal billing rate, students. The cost of which is measured at 2% of the normal billing rate. No such discount was offered to Modi Industries. No such discount, students, was offered to Modi Industries. Now you tell me one thing then. The credit was given in nano. When I am giving a credit versus if I am making a payment in cash, so in the credit the price would be high. And if the price would be high, the margin would also be high. So in the case of nano, because the credit factor is there, in the case of nano, students, because the credit factor is there, students, accordingly what we will say, since there is a credit factor in the case of nano, we will say in this particular case that, what is that, students? So we shall say, students, in this particular case that since there is a credit factor which is involved, accordingly the price charge would be on a higher side, and therefore the margin which is charged in respect of the international transaction with the AE would be on a higher side. And therefore what I need to do in the comparable margin, because in the comparable credit is not there. In the comparable the credit is not there. So therefore in respect of the comparable margin, I need to add this credit factor in this regard. Now see how beautifully they have set you up in this question. Up till now, this is what the ICI should be saluted, students. The salute should be done to ICI in this regard. In the first two adjustment, they are giving you 8% of the normal gross profit. In the second, they are giving it to you 14% of the normal gross profit, isn't it? So you become habituated that you will put across those 8% and those 14% of that normal gross profit, which is 60%. But suddenly in the last particular adjustment, what they have done, just to ensure that you make an error, they are telling you it is 2% off. Of what? Of the normal billing rate. Can you see that, students? It is 2% of the normal billing rate. And that exactly is the point. Now, accordingly, if you see, supposingly your normal billing rate is 100. The normal billing rate, students, in this context is 100. So with a normal billing rate, students, if it is 100, the normal billing rate, students, if it is 100, the margin percentage, students, the margin percentage which is being there over there would be how much, students? With the normal billing rate of 100, students, the margin percentage which you can see is what? The margin percentage, students, in this particular case is 60. Okay. And now, but this factor is 2%. So 2% of the billing rate. So is how much? 2. Up till now, whatever they were playing in the first two adjustment, the first and the second adjustment, they were all the percentage of the gross profit margin. So we were taking the percentage of the gross profit margin. But over here, the percentage that is to be applied, the percentage to be applied is not on the gross profit margin, but it is on the billing rate, and therefore it is 2. So I'm going to add 2 on this. So therefore, students, finally, what is the amount? Can you tell me, Prem, what is 14% of 60? Or else you can see 8.4. So this 8.4 is what has to be reduced. 8.4. So now students, if you all see, so adjusted gross margin would be how much? Adjusted gross margin would be 60 minus 4.8 minus 8.4 plus 2. 60 minus 4.8 minus 8.4 plus 2. That will be your adjusted gross margin. So what is that, students? This would be how much? 48.8. Now there is another catch point over here. And what is that? Be careful. Students, in the cost plus method, we require margin percentage. And that margin percentage will be added to the cost. That margin percentage, students, will be added to the cost. Do you all agree to this one? That margin percentage will be added to the cost. And since the margin percentage has to be added to the cost, therefore, students, therefore what? Since the margin percentage has to be added to the cost, students, therefore, in this particular case, what is that we will say? The fact that the margin percentage has to be added to the cost, therefore, students, we shall say in this regard that we shall say, students, in this regard that we will require a margin percentage, the margin as a percentage of cost. We will require the margin percentage as a percentage of cost, because only then I can add na cost. You need to add the margin percentage, so that margin has to be on the cost. What about in this question, students? What about in this question? In this question, they have told you 60%, the gross profit is 60% on Modi Industries work. So they are telling you that the gross profit is 60% on the Modi Industries work. So therefore, in a way, we can say that the question is silent. In a way, we can say, students, that the question is silent, isn't it? Because simply put, what they are trying to tell you is that the gross profit is 60% on the Modi Industries work, students. That is it. Nothing else is what they have mentioned. And with this particular scenario, what would be the final conclusion, students, that we will draw upon in this context? So we will say in this regard that with 60%, the gross profit of 60% on the Modi Industries work, if that is the case, so our final conclusion, students, would be that this is a percentage of sale. Because if the question is silent, generally then you go with the way the normal interpretation work. And what is the normal interpretation? The normal interpretation is that then in this case, the gross profit will be considered as a percentage of selling price. Because that is what we always say. If only it is said that gross profit is a percentage, that's it. So it is always a percentage of sales. And that is also the assumption, therefore, which is made in this question. That this 60% is nothing but a percentage of sale. And this also is supportive to this entire adjustment also. Everywhere we have got this percentage of billing rate and everything. Like last one also, point number 3. If you see point number 3, you have taken 2% of the billing rate. So all these are supportive to this particular thing, that this 60% which has been given as a gross profit, and the question is silent whether this gross profit is on sale or whether this gross profit is on cost. So if the question is silent in respect of that, accordingly we will go with the gross profit as a percentage of sale. The gross profit as a percentage of sale, students. And since if it is a gross profit as a percentage of sale, I need to convert it into the cost. I then need to convert this into the cost. And then how do I convert this into the cost? So you have this 48.8 finally, which is the adjusted gross margin. After the comparable adjustment, you get this 48.8. So this 48.8 is the margin on the cost. Margin on the profit. I need to convert it into the cost. How is the conversion taking place, friends? If you can recall the conversion concepts and all. Remember this 1/3 on sales is how much on cost? we used to always do this arithmetic. Like 1 is the profit, 3 is the sale. So 1/3 on sale in that case. So it is 1 divided by half on cost. So this is what we used to do. So this 1/3 on sale will become half on cost, students. All of you will agree to this one. And that exactly is the point. 1/3 on sale will be half on the cost, students. And accordingly, same approach you will have to do. So if it is 48.8% on sale, 48.8 on the sale, then how much on the cost? So it is, you have to reduce from 100, 48.8, and that will fetch you in the cost. So 48.8 divided by 100. If this is on sale, then how much on cost? 48.8 divided by 51.2. This would be on the cost. So on the cost, it would be 51.2. On the cost, students, it would be 51.2. I hope that all of you are clear with this one. Every one of you. And that exactly is the point, students. So therefore, students, in this context, this is what we all get it. This is all what we get it. And with this then, what is the cost? 20 lakhs. Cost in the A transaction is 20 lakhs. So with cost in the A transaction 20 lakhs, 48.8 divided by 51.2. So this cost plus margin. Cost plus margin. So what is the adjusted margin? So margin is 48.8 divided by 51.2. This will give you the ALP. Can you get me the answer, students? And how much is the arm's length price? The price which should have been charged? Quickly, students, the price that should have been charged in this particular case. Keep the calci beside you, students. How come it is? Let's see the solution itself then. 20 lakhs plus 19 lakhs 6,250, and that is your, so this is your margin, and with the margin your should be a billing rate. The billing rate should be, the ALP is 39 lakhs 6,250. Against that, what is the actual billing that you have done to Nano INC dot? Your actual billing is 31 lakh 20,000. So you should have had the profit and loss account credit side. Your credit side should be 39 lakh 6,250, whereas in actually it is 31 lakh 20,000. So there is an under value, there is an under reporting, and accordingly, students, in this case 7 lakh 86,250 would be the total income adjustment. Students, it goes without saying, you should be aware of this fact. Remember, there is a case for, students, there is a case for this under reporting. In the transfer pricing law 270A, this would result into an under reporting. In the transfer pricing law 270A section is there, wherein, in the penalty under section 270A, this will result into an under reporting. But students, there is one particular case, wherein this will not be considered as an under reporting. Can you tell me which is that case? There is one particular case wherein this will not be considered as an under reporting. Even if you are doing the additions of 7,86,250, still this addition of 7,86,250 will not result into an under reporting. Can you tell me this, in which particular case this can happen? So students, this is in respect where the SSE has maintained the books and records as per section 92D to support its transfer price. The SSE has maintained its books and records under section 92D. Then the law says that in such particular case, students, this books and the information that has been maintained the books and the information which has been maintained in this regard, we will say that, what is that, students, we are going to say? We shall say, students, in this regard that this will not result into, this, students, will not be considered as a case of an underreporting. This will not be considered as a case of an underreporting. 92D, this is a local file. Okay. So this is one part that you should always keep in mind, because it's an important interlinking. Okay. Otherwise, any additions which are made by adoption of the arm's length price, any addition that is made on the total income on account of the additions which are made, any additions which are being made on account of the adoption of the arm's length price, such additions are considered as an underreporting of income. Such additions are considered as an underreporting of an income. Thereafter, students, thereafter what? Once this is considered as an underreporting of an income, thereafter what we will say? That such underreporting will attract penalty of section 270A. But only in one case this penalty under section 270A can be avoided, and that would be when the SSE has maintained the documents, books and the file as required under section 92D. As required under section 92D. After this question we'll do later, question 464, because that is to do with other particular multiple things. So we will now move further herein. Now this is a really good question. Question number 465. Question number 465, students. Now, students, if you all see this particular question very carefully, Duplex Inc. Dot, a UK incorporated company, holds 30% stake in Duplex Limited, an Indian company. So obviously they have become the associate enterprise by virtue of this relationship. Duplex Limited sold 500 units of raw material at rupees 9,700 to Duplex Inc. UK during the previous year 21-22. So students, this is about what? The transfer price. So you have been given the transfer price at 9,700. Thereafter, students, Duplex Limited has sold similar raw material to the other unrelated parties. Fine. Further, Duplex Inc. transferred shares of SS Limited to Duplex Limited without any consideration, students. So this transfer that has taken place of shares of SS Limited to Duplex Limited is without any consideration. Now, students, for the time being, you just have to skip this information because this is for IFOS. In IFOS, remember, there is a gift tax. So this is to do with that gift tax angle, which I'm not considering right now. We'll discuss it later on. So this is about that. Now the fair market value of the shares of SS Limited is rupees 2,50,000. Again, this entire information you can skip. This is the IFOS part. Now let's take the things further. The details of supplies of similar raw material to other unrelated enterprise. So while the sales to Duplex Inc. Dot was at CIF, be careful now, students. Just students, read this particular part now. From here you start reading in this context. So there are two comparable students which has been given in this regard. And with the two comparables, so while the sales to duplex INC dot was at CIF rupees 200 per unit for insurance and freight, and at X warranty price, the sales to nano INC dot was at FOB. So be careful students, duplex is your associated enterprise. To your A you are selling it at CIF, whereas to your uncomparable, that is unrelated party, it is at FOB. So if it is at FOB, I will make it at CIF. Why I have to make it at CIF? Because I told you already that you have to adjust to ensure that the price of the comparable so arrived is having the same factor, as in the A transaction. As in the A transaction, students. Isn't it? So therefore, if the A transaction is at CIF, comparable is at FOB, so please make that comparable also at CIF. Please make the comparable also at CIF, students. I hope that every one of you are clear with this one. So therefore, to make this at CIF, students, what I am going to do in this regard, herein, we will add in this case, so you have 10,500, they have given to you 300 rupees for the insurance and freight. So this, on this 10,500, you will add 300 which has been given it to you, isn't it? You will add this 300 which has been given to you. Now students, at the same time, this price is X warranty. This price is X warranty. A transaction is at X warranty, comparable is at cum warranty. So what I'm going to do, I'm going to make the comparable at X warranty. How much is the warranty factor in this case? 500. So if 500 is a warranty factor, I am going to reduce this 500 from the price of the comparable, because the warranty cost is loaded in the price. So I need to offload the warranty cost from the price so as to make it at X warranty. Students. Okay. Now students, the beauty of this question is that this question has got two comparables. And in both the comparables, you are required to do the adjustments and finally arrive at the ALP. So two comparables are there and you need to do the comparable adjustment and arrive at the ALP. By the way, which is the most appropriate method which you are applying in these two comparables? Which is the MAM that you are applying in these two comparables, and the MAM which you are considering, which is applied in both the comparables, is the CUP method. The comparable uncontrolled price method. So we are following the CUP method over here, and based on the CUP method, we are trying to determine our ALP on these two comparables. Okay, so I'll get two ALPs, and once I get two ALPs, remember that, then I will have to do the average arithmetic mean, and once I do the average arithmetic mean, thereafter I will compare this with the transfer price. Then I will see the difference and I will check whether the difference, does it exceed 3% of the transfer price, and if it exceed 3% of transfer price, then the transfer price will be rejected and the ALP would be the arithmetic mean, the average. But where the difference is not exceeding 3% of the transfer price, then in that particular case, I will accept the transfer price and will ignore the ALP. Accept the transfer price and will ignore the ALP. So students, see the second comparable. In the second comparable which they have given to you, similar raw material was sold by Y Limited to Z PLC UK, uncontrolled transaction, at rupees 9,500 per unit. At rupees 9,500 per unit. The price charge is 10,000 quantity level, students. So therefore, if you see, there is one uncontrolled transaction at 9,500 per unit, and in that the price charge is at 10,000 quantity level. whereas the price charged by Duplex Limited to Duplex INC dot is at 3000 quantity level. So in first there is 10,000 quantity level, here it is at 3000 quantity level. So obviously you can just imagine in this context with 10,000 quantity versus 3000 quantity. So your comparable, the second comparable is at 10,000 quantity level, whereas the A transaction is at 3000 quantity level. So I need to bring down the price to 3000 quantity level even for the comparable. And then how do I go with this? So they have given you the range, the quantity level range, and what is the price that will be charged in that range. So I need to pick up the 3000 quantity level because this is the quantity level of the international transaction. So at 3000 quantity level, the uncontrolled transaction which would have been entered would be at rupees 10,500 per unit. 10,500 per unit. So therefore I will pick up 10,500 per unit because this is the price which would have been entered if the comparable would have entered at 3000 quantity level instead of 10,000 quantity level. So therefore the price would be 10,500. That would be taken in this regard. So accordingly, students, you now have both the ALPs. So ALP from the first one, students, is how much? 10,500 plus 300 minus 500. So this is 10,300. So from the first I get the ALP. From the first comparable I get the ALP of 10,300. From the second comparable I'm getting the ALP of 10,500. Please take the average, and the average in this particular case would be 10,300 plus 10,500. You divide it by 2. Divide it by 2, students, and that therefore the divided by 2. So your arithmetic mean would be 10,400. Arithmetic mean would be 10,400. Now how much is your transfer price, students? Transfer price is 9,700. So the price that you have sold is at 9,700, isn't it? And accordingly you will come to know the difference is 700. Now can you tell me 700 divided by 9,700, is it more than 3%? The difference divided by the transfer pricing, the difference divided by transfer price. So therefore, is it more than 3%? Yes, it is more than 3%. And if it is more than 3%, what did we said? We said that in such case the transfer price will be rejected and the arithmetic mean will be the final ALP, and accordingly the 10,400 will be the final ALP which will be adopted, and thereafter you will be subject to a transfer pricing adjustment. And how much will be the transfer pricing adjustment? 700 rupees per unit. 700 rupees per unit, students. I hope that all of you are clear with this one. And that exactly is the point. So students, this is how the things has to be looked upon over here. Fine, students. So this covers up this question. Now we go to this we have already done, students. This is the repetitive. The thin capitalization, the same question. In fact, this is targeted 2 times in our compiler. So we'll skip this question because we have already done this. Now students, this is your homework. This Amar Limited is your homework. This is the same cost plus method. So we did nano. And this is Amar Limited. So Amar Limited, you will take up homework. Question number 467, you just take a note of it. This will be your homework, students. Now let's have a look to question number 468. State with reason whether Netlon LLC incorporated in Singapore and Briggs Limited, a domestic company, Briggs Limited, students, a domestic company, are or can be deemed to be an associated enterprise for the transfer pricing regulation. So can they be considered as an AE for the purpose of the transfer pricing regulation? And students, each situation is independent of the other. So we have to take each cases on merit. Let's have a look. Point number 1. Netloan LLC has advanced a loan of rupees 53 crores to Briggs Limited on 12th of January 2022. So that is the amount of loan of 53 crores to Briggs Limited on 12th of Jan 2022, students. So they have advanced the loan of this much amount of rupee. The total book value of assets of Briggs Limited is rupees 100 crores. So this becomes your total book value. So we have, and they have advanced a loan of 53 crores to Briggs Limited on the 12th of Jan 2022, and against that the total book value of assets of Briggs Limited is how much? Rupees 100 crore. So students, if you remember in this case, now thereafter they are also giving you the market value of the asset, however is 150 crores. Please recall in 92A, the definition of associated enterprise, the loan which has been given to you is compared with what? To determine, students, to determine whether the two entities, the borrower and the lender entity, whether the two entities are an associated enterprise. My question therefore to all of you is, the loan is compared with what, students? The loan is compared with the market value of the asset or the book value of the asset, students? It is the book value of the asset. Can you see that? It is the book value of the asset with whom it is compared, and that exactly is the point. And accordingly, you will say, what are you going to say? 53 crores divided by 100 crores. 53 crores divided by 100 crores. Now, is this more than 51%? Yes, it is. And therefore, can they be considered to be an associated enterprise? And the answer is yes. Now, if you see point number 2, Netloan LLC has the power to appoint 2 of the directors of Briggs Limited. Students, unfortunately, 2 directors, how many? The total number is 4. To become an A, you need to have the power. The power should be to appoint more than 2. More than means more than 50%. They have said more than 50%. So more than 50%, students, is what is required. And unfortunately, students, here, which we can see, it is what, students? It is equal to 50%. That is so unfortunate, isn't it? So this is equal. This, in this context, students, it is equal to 50%. And that is the reason why, students, we will say that since it is equal to 50%, we will say that both of them are not an associated enterprise. Coming to the third one. Total value of raw materials and consumables of Briggs Limited is rupees 900 crores. Of this, Netloan LLC supplies to the tune of 820 crores at a price mutually agreed upon once in 6 months and depending upon the market condition. Now, so far as the raw material, students, 92A says that if the dependency of the raw material procurement is of 90% or above, dependency on an entity towards the raw material procurement of 90% or above, then both the entity will be considered to be an associated enterprise. So I need to check whether my dependency on that entity to procure the raw material, is it to the extent of 90% or above in this case. So you can say that the total raw material is 900 crores, of which I am purchasing from Netloan how much? 820 crores. So obviously it can be seen that the dependency is more than 90, and since the dependency is more than 90, accordingly both of them would be considered to be an associated enterprise. Both of them would be considered to be an associated enterprise, students, and that exactly is the point. Now students, I want all of you to first go through this question, solve this question, students, at your end. 5 minutes I'm giving you the time. You need to solve this question at your side, students, in this context. Okay. 5 minutes time, solve the question in 5 minutes. That we'll see, Prem. I'll just check into this. 5 minutes time. Let me see what you all do. Don't see the solution, students. Please get into that. And thereafter, I have to explain you one very important concept of transaction net margin method. One important concept I'll explain to you. But before I explain to you that concept, I just want all of you to solve this in 5 minutes. 5 minutes time, students. Maximum in the examination also. Quickly. In the examination also you will deal with the same way. Get started, students. Prem and all the students. So solve it, Prem. So students, this is a question, as you can see, of the transaction net margin method. Before you in fact look in before I go to this question, no, this is not similar to resale this thing. This question, if you have seen, this is similar to what? To the cost plus method. Now that is the beauty of, students, that is the beauty of the transaction net margin method. Transaction net margin method, you have to be extremely careful. You will find that this could be a bit tricky. See, this is what it happens in the case of transaction net margin method, students. In the transaction net margin method, it has got two variants. TNM method has two variants. The first variant, students, in this case is that of the cost plus method. So it will appear to be similar to the cost plus method only. Obviously, when we do practically, because there are many data which is involved in practical context, many data are involved. So when you do this thing practically, you will find the difference between the two. But as far as your examinations are concerned, when it comes to your examination, you will find both the methods to be similar. Both the methods to be similar. Now the second particular method, students, which has been there, the second particular method, students, which has been there is the variant of the, this is the like net resale price method. This will act like a net resale price method, students. Now this net resale price method which has been there in this context, how does it operate? The net resale price method, students, how does it operate, students, in this context? So let's have a look in this regard for the net resale price method, students. So the net resale price method which has been there given to us will operate in the following. Will operate in the following, students. So this is the way the operation will be done. Let's have a look. Let's have a look, students, over here. So this is your non-resident A. This is your non-resident A, students. And the non-resident A which has been given to you. Then there is resident A. Let me put it across this way. Resident A. Now they are supplying the goods to them. So supply of raw material, This is your international transaction. Okay. And thereafter they will charge the transfer price, in which the transfer price will be charged. Transfer price will be charged. Now this resident A students will thereafter will do what? They will process the goods, process the final product. So they shall process the final product, students, in this case. In this context, process the final product, students, in this context. Now, with processing the final product, students, in this context, thereafter what we will be getting it? Accordingly, once they are processing the final product, students, be careful. Once they are processing the final product in this regard, be careful on this, students. The situation would be like this, that once you process the final product, then they will sell the same. See the combination, students. Okay, yes, Prem. Final goods would be there and they will be selling it. See the combination, because this is very important. Tell me one thing, whether in this case resale price method, can this be applied with this combination if it is given to you in the question? If this combination is given to you in the question, whether you can apply the resale price method, students, what is your take? Answer is definitely no. Resale price method would require that you will be purchasing the goods and the same goods would be sold. Whatever has been purchased from your AE, the same goods would be sold. That is the case where the reselling price method would be made applicable. The reselling price method would be applicable. So that is the place where the reselling price method would be applicable in this regard. Do you all got this one, students? Fine. The next particular part, if you see, students, over here, so this is the non-resident AE supplying the goods to the resident AE, thereafter process it to the final product, and finally it is being sold. So now let's have a comparable. Unrelated party supplies to unrelated. So supply what? Similar raw material. Okay, process it to the final product. And then thereafter they will be selling it. This is the comparable information that they will give it to you. This is the comparable information, students, that they are going to give it to you. And once you get this comparable information, now what you need to do, students? You need to now, students, develop a net margin. So what you need to develop, students, in this case, you will be getting a net margin. So here you will have your net margin, students. Here you will have what? Your net margin. And with this net margin, students, with this net margin which you have got it, you will then come across with the net margin percentage. So this net margin, then you will get your net margin percentage. Net margin percentage. So therefore, in this context, students, net margin percentage is what you will get it. As the name suggests, students, This is the net margin percentage, students, which has been there. So now what I'm going to do about this net margin percentage? This net margin percentage, students, I am going to do what in respect of this one, students? Indeed the case. Students, please understand, in the case of resale price method, I used to take up the gross margin. That is what I used to do. That gross margin was then taken above. To reduce it from that particular selling price. And then I used to go back to here I used to go back, and then I used to do the adjustment relating to the uncommon factor. That is what we used to do it. But over here, students, here what I have to do, how different this with the resale price margin is. The difference is that in the net margin percentage only you will do the adjustment relating to the uncommon factor. Adjustment relating to the uncommon factor. So the adjustment that is done would be in respect of the uncommon factor, students. The adjustment that would be done would be in respect of the uncommon factor. Okay? From the net margin, and by virtue of which, so this is your step 1 primarily. This is your step 1. By virtue of this, you will be getting what, students? Adjusted net margin percentage. So compare this, students, with the resale price method. In the resale price method, we never used to do the adjustment on the gross margin. We used to do the adjustment at the last stage in the resale price method. Whereas over here, the adjustment is to be made in the net margin itself. And that exactly is the point, students. I hope that all of you are clear with this one. All of you. So this is your adjusted net margin percentage, students. If you all are through with this one, adjusted net margin percentage, students, is that being done with all of you? Fine. So now you will take this adjusted net margin percentage above. Once you are done with this, students, you will now take the adjusted net margin percentage above. How you are going to do that? Let's have a look to this one, students. Have you copied on up till here, Prem? Copied up till here, students. So this will fetch you the adjusted net margin percentage, and now after this, now you will reduce it. Here is the step 2. So the step 2 that is going to be there, reduce the adjusted net margin percentage. So this is what you're going to reduce from here. Adjusted net margin percentage is what you're going to reduce it from here. So you net margin percentage, if you reduce after step 2, so this is your step 2. This is your step 2. Adjusted net margin percentage would be reduced, students. So once you reduce the adjusted net margin percentage, you will reach at this particular place. After reducing the adjusted net margin method, you will reduce here. So now the step 3 would be, reduce the additional processing cost So additional processing cost, students, needs to be reduced from with the amount as per step 2. So whatever is the amount that you have arrived as per step 2, students, whatever is the amount that you have arrived as per step 2, you will reduce the additional processing cost now, and that is what will give you the ALP. On step 3 working, students, you will be getting your ALP, and once you get your ALP, compare this with transfer price. This is your step 4. Compare this with transfer price, students, which is your step 4, and that will result into the transfer pricing adjustment. That will result into your transfer pricing adjustment, students. Is that clear to all of you? That will result into the transfer pricing adjustment, students. I hope that all of you are clear with this one now. Every one of you. And that exactly is the point. So this is what, students, this is. So how do you identify in the question that this is a transaction net margin method with the variant of, this is a variant of the resale price method, isn't it? So it is like it's a variant of a resale price method. The difference, how do I identify the difference between the resale price method and this transaction net margin method? So the difference would be that in the resale price method, whatever is the goods which I have purchased from the AE, the same goods I am reselling it. Whereas over here, I do a bit of further processing, and after processing, I am selling the goods. After processing, I am selling the goods. So this is how I actually understand the difference. Now, what is the key difference in the steps in the resale price method versus the steps in the transaction net margin method? So the key difference that we can see very categorically and very clearly, students, is that in the net margin that we compute, the net margin percentage is adjusted with, the net margin percentage, students, is adjusted with these particular uncommon factors. The net margin percentage, students, is being adjusted with the uncommon factor, students, and that exactly is the point. I hope that all of you are now clear with this one. Every one of you. And this is how the things has to be considered. Yeah. So students, with this we are done with this particular proposition now. We are through with this particular proposition, students. So with that now, let's try to take the discussion forward. Let's try to take the discussion, students, forward. So over here now, students, if you all are through with this one. Over here now, students, if you all are through with this one. In this context. So this, because the question that you have solved, Prem, was the transaction net margin method with cost plus side. Up till now, ICI has not targeted, students. ICI has not targeted this side. And that is the reason why I made a detailed analysis, so that at least you people are prepared. ICI is yet to target this particular side. So ICI has targeted a TNMM with the cost plus variant. It is actually like a cost plus method only, which you would have seen. So in question 469, if you can, we can just quickly run through it. Beta INC dot, having its business in Singapore, has advanced a loan of Singapore dollar 1,60,000 to Beta Limited, Mumbai. Book value of the total asset of Beta Limited was rupees 125 lakhs. Beta Limited provides software backup support to Beta INC dot. So that is a software backup support which has been given to Beta INC dot, students. Now Beta Limited has spent 50,000 man hours during the financial year 21-22 for the services rendered to Beta INC dot. For the services rendered to Beta INC dot. So students, this is your, already students, you've got what, students, over here in this context. So first of all, one thing before we proceed, students, loan of Singapore dollar 160,000. Book value of total asset is 125 lakhs. So by virtue of this, you need to establish in your answer whether they are an associated enterprise or not. So first and the foremost thing is that you need to convert this Singapore dollar into INR. that conversion would be required. So if you see over here, it is Singapore dollar 75 rupees per man hour. So Prem, 72 lakhs. Students, you get 72 lakhs. So 72 lakhs divided by 125, definitely it is more than 51%. And by virtue of which both of them can be considered to be an associated enterprise. Now looking into this, Beta Limited has spent 50,000 man hours during the financial year 21-22 for the services rendered to its non-resident A, which is Beta NC dot. The cost for Beta Limited is 75 Singapore dollar per man hour. This is a cost because, as I told you, this will become a cost plus method variant. So Singapore dollar, students, is 45. Anyways, Beta Limited has billed. So this is your transfer price, and this is the transfer price which is under the question whether what I have billed, is it as per the ALP or not. That is what is under the question right now. We will see that. Below this, Gamma Limited in Mumbai, which has a similar business model, provides software backup support to Olive Inc. dot in Penang, Malaysia. So this is comparable information. Gamma Limited cost and the operating profit are as under. See, from the associated enterprise transaction, what I require is the cost, which I have got it. How much is that? $75 per man hour. So what I require from my associated enterprise is the cost, which is 75 Singapore dollar per man hour. That is what is already being provided to us in this context. Now below this, if you see for the Gamma Limited, below this, students, if you all see with the Gamma Limited in Mumbai, so Gamma Limited cost and the operating profit are as under. So if you see over here, the direct cost 600, indirect cost 200, operating profit 200. So Gamma Limited cost and the operating profit are as here under. Direct cost 600, indirect cost 200, operating profit 200. Thereafter, if you see below, calculate the ALP for the transactions between Beta Limited and Beta NC dot based on the above data of Gamma Limited using the transaction net margin method. So using what? The transaction net margin method, you need to calculate the ALP for the transaction between Beta Limited and Beta NC dot. And thereafter explain if there is any adjustment to be made to the total income of Beta Limited. So students, if you can see it over here, primarily, what exactly we all will get it in this question. So over here, students, we need to get the operating margin, students. What is the operating margin? Comparable operating margin. The comparable operating margin also has been given. How much is that? 200. Comparable operating margin, students, has been given as 200. So 200, and how much is the operating margin on the cost? Cost is 800 for the comparable. So it is 1/4. So it is 1/4. Isn't it? So this is 1/4, which is 25%. So 25% is the operating margin. Now, have they given in the question any uncommon factors between the two? Between the comparable and the non-associated enterprise transaction? Have they given to us any comparable transaction between any comparables between the two? And the answer is no. We don't have any comparable, students, in this regard. And the fact that we don't have any comparable, students, in this regard, what is that we have to do then? So with the absence of the comparable information, students, simply put, this is 1/4 that has been given to us. This is the 1/4 that has been given to us. So what we will do, 1/4, I'll just add to this one. So 1/4 I'm just going to add, just like the cost plus method. The cost in the A transaction plus the comparable margin adjusted comparable margin. Here no adjustment is required, so directly 1/4 will be added to 75. So therefore, how much you will get it in that case? 75 plus 1/4. How much is your? Then that will give you the ALP. Quickly, 1/4 of 75, and you need to add this. What is your ALP, students? You should be in a position to tell students quickly. It's a plain mathematics. Where is the calci, students? 18.75. So 75 plus 18.75 comes to how much, students? 75 plus 18.75 comes to, in this case, is it 93.75? 93.75, students. So this is the price at which you should have charged. 93.75 is the price that you should have charged. How much you have billed? What is the price you have billed? You have billed at 90.75. Your billing is 90.75. What is the difference? Difference is 3. Difference is 3. Now 3 divided by this transfer price. Difference divided by the transfer price. Is the difference more than 3%? Answer is yes. Is the difference more than 3%? The 3 divided by transfer price of 90.75, is the difference more than 3%? Yes, the difference is more than 3%, students. And if the difference is more than 3%, in that case, we will then say that the transfer price will be rejected. The transfer price will be rejected, and accordingly, if you reject the transfer price, students, then as you are aware, the ALP would be adopted in this regard, students. By rejecting the transfer price, students, in this particular case, which you are doing it over here, simply put, then, students, what you are doing it in this context. So here, in students, in this regard, reject this particular part, and then this is the final difference. So this is the ALP. Multiply into INR into 45. Into 45 you multiply by the INR, students. In this context, are you getting in INR 4218.75? Quickly tell me this. Into 45, sorry. 93.75 into 45. Into 45. Into 45. So we'll get 4218.75, students. We get 4218.75. All of you agree to this one? So this is what it should be, a billing rate in INR. So that is exactly the point. Into number of man hours, 50,000. So the total amount which is there should be this much. Whereas in actually it is how much? Actually it is 20 lakhs 41,000. No, sorry, 20 crores 41,087,500. So therefore, in this case, students, you can easily make it out that this is actually a 3%. This is, students, actually a 3%, isn't it? This should be actually a 3%, what we have discussed. So therefore, this is your 3%. In fact, I could have also done through the 3% category also, but let it be, because you have to show the entire step. So please don't do the shortcuts, because your marks will be deducted. So therefore, apply the entire thing, because it's easy to get that 3% and tell directly how much is our transfer pricing adjustment. So we can get this 67,50,000 directly also. by taking the 3%, because already we have calculated 3%, which is the difference. The 3 rupees is the difference, isn't it? So with 3 rupees as a difference, see how this will work. 3 rupees difference was $3 was difference. $3 was a difference, which we have seen, into 45 per dollar into 50,000 into 50,000. So if I do with this approach, then in that case I will get the same 67,50,000. But don't do this, students. You will not get full marks, although your final answer will be right. Is that clear to all of you students now? All of you. With that, students, we are done with this particular part also. Now, students, let's look upon to this. Because that ultimately is the difference. Na? If it is more than 3%, then the difference is your adjustment itself. That is what we'll say, isn't it? If your difference is more than 3%, then that difference itself is the adjustment, students, isn't it? So that is what it is. Now, one question that you were asking about question 468. Question number 468, the third answer is incorrectly printed. Let me check about the anomaly. What was this? So here we have said that more than 90% is there. Okay, yeah, you can just make the correction, friends. They are deemed to be associated enterprise. They are deemed to be the associated enterprise. Did you all make the correction, students? Fine. So let's proceed further now, students. ABC and Company and Indian LLP is solely engaged in the manufacture and export of engine parts, including okay. Students, just hold on. Yeah, just forgot. We have not read the full question. Students, this is the real problem of not reading the question entirely and working it on the haste. Can you see that? At prices mutually agreed upon once in 6 months and depending upon the market condition. Now, in this particular context, the price therefore is not influenced with. They are very categorically saying that the relationship will not influence the price. What will influence the price would be? The relationship will not influence the price. The relationship that because that I am having the requirement or procurement of raw material, then in that case the relationship by itself will not influence the price. What will influence the price? We will every 6 months, we will freeze the price based on the market condition. Based on the market condition, whatever it is, we will freeze this particular price of the raw material procurement. So it is very clear that the relationship is not influencing the price, and because the relationship is not influencing the price, therefore this particular associated enterprise definition will not apply in this regard. I hope that all of you, so this is what it is. If you only read a particular part, then in that case this would become suicidal. Therefore, it is required that we should read the full particular question and see the error that we have done by missing this particular important data. So therefore, in this particular question, they are very categorically saying that this relationship of that my raw material procurement from the other party is more than 90%, but the fact remains that the price at which the raw materials is procured is completely based on the market condition, which we will assess every 6 months. Therefore, it can be said that the relationship is not influencing the price of the transaction. The relationship is not influencing the price of the transaction, and because the relationship is not influencing the price of the transaction, therefore what? Therefore, they are not an associated enterprise. Fine, students. Now, safe harbor rule. Prem, have you seen that video of safe harbor rule which I have put across? This question I have solved. This question, if you see, we have solved in the safe harbor rule video. So please do ensure to see this particular safe harbor, because this sort of a question is very, very important in this regard. Okay, so just do ensure that this is something which has been there in this context. Let me in fact run through this particular question. ABC and Company, an Indian LLP, is solely engaged in the manufacture and export of engine parts, including the cooling systems and engine valves. It had supplied auto components worth rupees 72 crores during the financial year 21-22 to XYZ LLP, a foreign LLP located in Germany, controlled by A and B. इंटरनेशनल टैक्सेशन अगर रिवाइज करना है तो मैं तो आपको सजेस्ट करूँगा आप प्रैक्टिकल से रिवाइज करो, क्योंकि थियरी बहुत खेल लिया और थियरी में चीज़ें पकड़ में नहीं आती है. मेरा आपसे निवेदन है कि आप इंटरनेशनल टैक्सेशन को रिवाइज करें डायरेक्टली थ्रू प्रैक्टिकल्स. तो अगर आपने पहले कर लिया है तो इंटरनेशनल टैक्सेशन को, नहीं किया है तो फिर तो नॉर्मल तरीके से पढ़ना पड़ेगा, isn't it? तो सीधे प्रैक्टिकल पे जंप करिए आप, नहीं तो थियरी में है ना पकड़ में नहीं आती बहुत सारी चीज़ें. जहाँ से भी आपने पढ़ा होगा, जिस किताब से भी पढ़ा होगा, आप जरूर से उसको एक बार करें. और एक है, मई में दिया एग्जाम तो अब सिर्फ प्रैक्टिकल करो. आप डायरेक्टली जो क्वेश्चंस हैं वो करो, और ICI के MCQs भी जरूर से देख लेना, क्योंकि उनके MCQ बहुत बेहतरीन है. सो डायरेक्टली रिवाइज आप करें थ्रू दी केस स्टडीज एंड प्रैक्टिकल्स. थियरी छोड़ दो, थियरी को आप रेफरेंस के रूप में लीजिए. ठीक है, थियरी जो है ना आप उसको रेफरेंस के रूप में लीजिए. जहां अटक गए देख लिया थियरी. ठीक है, तो ये मेरा सजेशन है आपसे कि आप ऐसा करोगे तो आपका कॉन्फिडेंस बढ़ेगा. नहीं तो अननेसेसरी क्या होगा कि ऐसा आपको लगेगा कि आता तो सब में, पता नहीं कहाँ पे हमारा ये मार्क्स हमें मिल नहीं पा रहा है. ये अंदर से काफ़ी फ्रस्ट्रेशन आ जाएगा कि आता तो सभी चीज़ है लेकिन पता नहीं फिर क्यों नहीं हो रहा. ये प्रैक्टिकल्स अगर हम करते रहेंगे ना, स्पेसिफिकली इंटरनेशनल टैक्सेशन ही 30 मार्क्स का ना, और वो देखो एक सीमित है, इट इज़ लिमिटेड. अनलाइक कि बाकी सिलेबस अगर आप देखोगे तो बहुत डिटेल्ड है. इसको एक बार अच्छे से कर लिया तो आपका बहुत हद तक आपका क्या हो जाएगा, चीज़ें काफ़ी सॉर्ट आउट हो जाएंगी. ठीक है, चलिए, ऑल द बेस्ट. अब स्टूडेंट्स, now let's have a look to this particular part. ABC and Company, an Indian LLP, is solely engaged in the manufacture. All the best. Is solely engaged in the manufacture and export of engine and engine part, including cooling systems and engine valves. So students, this export of engine that we are talking about it, this is your core auto component. Now since Prem, you have not seen the safe harbor rule YouTube video, so just bear with this question. But students, in the safe harbor rule, we have got supply of core auto component as a notified transaction in the safe harbor rules. supply of core auto components is considered as a notified transaction in the safe harbor rules, and how much is the operating margin percentage that should be there in your transfer price. The minimum operating margin percentage that should be there in your transfer price is 12%. So the Indian associated enterprise which is supplying the core auto component to its non-resident AE, that particular price which is charged by the Indian AE should have a minimum operating margin of 12% of the operating cost. So 12% of the operating cost. This should be your minimum margin that you have charged in the transfer price to your non-resident AE. So in the transfer price charged to the non-resident AE, the minimum margin should be 12%. Let's see. Is it the case? Because if it is 12%, minimum 12% is there, then no transfer price adjustment is to be made. Then no transfer price adjustment, students, has to be made. If your transfer price is having a minimum operating margin of 12%, in respect of which transaction? The supply of core auto component parts. The supply of core auto component parts. Let's see. It had supplied auto component worth 72 crores during the financial year 21-22 to XYZ LLP, a foreign LLP located in Germany, controlled by A and B, the partners of Indian LLP along with the relatives. Against the aggregate value of transactions entered into, as mentioned above, the Indian LLP incurred an operating expenditure, this is important, of 60 crores, leaving an operating profit of 4.5 crores. So just check out, students, in this case, whether 4.5 operating margin, 4.5 crore divided by operating cost, is it 12%? Is it minimum 12%? Answer is no. This is not even, it is not even 10%. We can easily make it out. Leave us at 12%. So therefore, students, in this context, we will say that the minimum operating margin of 12% is not there in the transfer price charged by the Indian AE to its non-resident AE, and because the minimum operating margin of 12% is not there, therefore the transfer price will be rejected, and there accordingly, if the transfer price is rejected, will the ALP will be determined in this particular case? And the answer is yes. The transfer price will be rejected and the ALP will be determined in this particular case. Yes, gaming. It should be minimum 7.2 crores so as to make it as 12%. Perfect. So students, in this case, we can say, see the question. This is the examination question. Please mark this an important for November 22. Mark this. This is a very unique type of question, students, for November 22. So compute the primary adjustment required to be made for assessment year 22-23. Fine. If any, assuming that the Indian ALP has exercised a valid option for application of safe harbor. So how much is the primary adjustment? So how much should be the profit, students? 12%. How much should be the profit, students? 12%. So if 12% has to be the profit, students, can you tell me the amount? How much is the adjustment that will be required? So your profit is 4.5 crores, and as you told, it should be minimum 7.2 crores. So 7.2 crores is what will make it as 12%. 7.2 crores is what will make it as 12%. All of you agree to this? So I require the profit at 12%. Whereas you have shown the profit of somewhere around, how much was the profit? The profit that you are showing is 7.5. At 4.5, you are showing it at 7.5%. So our final conclusion, students, would be that the difference 4.5 and 7.2, this difference is what will be the primary adjustment that has to be made. My profit should be 7.2, but you have shown the profit of 4.5. So my primary adjustment would be the difference between the two, and the difference is 2.7 crores. The difference is 2.7 crore students. I hope that all of you are clear with this one in this context. And this is how the safe harbor application has to be done. Very important question, students. This type of questions are very important. So the difference is 2.7 crores. I hope that all of you are clear with this one. Let's look upon to our next question, students. Question number 471. Question number 471 now. I think we are now about to complete the transfer pricing. And after completing the transfer pricing, students, we will then move to assessment procedure. The questions on assessment procedure, students. Okay, let's start. Muskan Limited is an Indian company that manufactures kit in India, students. Manufacture kit in India. MK Limited is eligible for deduction under section 10AA of the Income Tax Act 1961. Okay. MK Limited, students, they have mentioned that it is eligible for deduction under section 10AA of the Income Tax Act 1961. For its UK sales, MK Limited has entered into a marketing arrangement with Kits Sports, a UK incorporated firm. So students, please be careful here now. Let's read further. MK India uses the patented design provided by KS UK for manufacturing of cricket kits by it. Students, be careful. Use of intangible. So if supposingly I am dependent on the intangibles of the non-resident AE, so the intangible dependency with the non-resident AE will make the relationship as an associated enterprise. If there is a dependency on the intangible to do your business, if there is a dependency on the intangibles of the non-resident to do your business, then that also will establish the relationship of associated enterprise. And therefore, students, they are deemed to be an associated enterprise under section 92A. So that is how it has to be considered. So it's a beautiful way of putting up the things. So MK India uses the patented design provided by KS UK for manufacturing of cricket kits by it. MK India supplied 30,000 sport kits to KS UK for rupees 5,000 per kit. So students, this is your transfer price. This is your transfer price. Now this is what has to be compared with the ALP. We'll see that. In the assessment, the assessing officer increased the price charged by MK to 6,000 per kit. So the ALP which the AO has adopted is 6,000 per kit. MK India accepts such transfer price adjustment adopted by the AO. So he has accepted it. As a result, there is an increase in the income of NK. Obviously, you are required to answer the following question in this respect. Would MK India and KS UK are treated as an associated enterprise for the purpose of transfer pricing adjustment? Answer is yes. The intangible factor we have already discussed. Point number 2. What is the liability of KS UK in respect of change in the arm's length price in respect of purchase made by it from MK India? So students, here in this case, this is the difference of 1,000. Students, difference of 1,000 in this case. So please have a look. Difference of 1,000 into what? 30,000. Isn't it? And that will be, is it more than 1 crore, students? Is it more than 1 crore, students? Answer is yes. This is 3 crores. Then do you know what will happen? Secondary adjustment 92C will come into play. What is the liability of this for? See, as far as, please be careful. Such a beautiful question this is. As such, there is no liability per se in India. The UK company, students, the UK company doesn't have to pay any income tax in India. Students, the UK company does not have to pay any income tax. It is the India Associated Enterprise MK India which is subject to the income tax liability. Okay, but what is the liability of the UK company in respect of this purchase transaction? So what happens is that if the difference is more than rupees 1 crore, if the difference is more than rupees 1 crore, then in that particular case, the amount needs to be received within 90 days from the relevant date. The amount should be received within 90 days from the relevant date. If there is a failure to receive the amount, then in that case, it will be considered as deemed loan. It will be considered as what, friends? As a deemed loan. And because it is considered as a deemed loan, this will become the liability of KSUK. He need to make the payment. So that will be the deemed loan. Third, MK India contends that since the income is increased because of the arm's length price adopted by the AO, the deduction claimed by it under section 10AA should also be increased accordingly, since the amount of deduction is based upon the amount of export sale. No, never. This will not happen, students. Now just one point, students, just very quickly. Just you should take this particular comparison. This is an important comparison. Students, the profit link deduction enhancement of profit linked deduction during the course of the assessment, on account of what? First is the disallowances of expenditure, and second is adoption of the arm's length price. Yes, gaming. So here if you see, if there's a disallowance of the expenditure, and because of the disallowance of the expenditure that the price has been enhanced, because of the disallowance of the expenditure, students, if the amount has been enhanced, then what is the conclusion that we will say? As you can see here in students, over here, students, because of disallowance of the expenditure, students, remember, students, this thing, you all answer me this particular point, students. If because of disallowance of the expenditure, students, if the profit has been enhanced, whether this will also result into the enhancement of the profit link deduction? Prem, gaming. Yes, it is like 4-5 compiler session only we have done it, and this is, I started with the non-resident taxation only. I started with the NR taxation only. Students, do you remember this particular part, disallowance of expenditure, where you will find? You will find while you were doing 80IA, 80IB, 10AA, there this note will be there. Wherever you students would have read it, in that note it is there. What is the note? The note is there that because of the disallowance of the expenditure, if the profit of the eligible business is enhanced, then such enhanced profit will qualify for the deduction. So therefore, the profit link deduction will be increased. The profit link deduction, students, will be increased in this case. Primarily. However, if the profit is increased if the profit is increased on account of the adoption of the ALP. On account of what? On account of the adoption of the ALP. If the profit of the eligible business is increased on account of the adoption of the ALP, then that will not result into a increase in the profit linked deduction. So this is what you people have said it right over here, but be careful. That is the reason why I made this comparison, because I knew that people will fumble over here. Students. So therefore, you can just take a note of it here in this context, adoption of the ALP in this context. So you will write over here, students, that as per the proviso to section 92C, you can just ignore this proviso to 92C if you want. Means instead of writing the section, you can at least write the provision. If the profit is increased on account of the adoption of the ALP, then it shall not result into a further enhancement of the profit linked deduction. I'm again telling you, friends, this you'll say, sir, where we will find this note? Wherever you have done your ATIA, ATIB 10AA, there this CBDT circular is also there, which have said that if in the course of assessment, if the expenditure is disallowed, then the profit which is enhanced of the eligible business, will qualify for the profit linked deduction. But in the case of transfer pricing, on account of adoption of the ALP, if the profit is enhanced, then such enhancement of profit will not result into the enhancement of the profit linked deduction. I hope that every one of you are clear with this proposition now. With that, students, we'll proceed further. If you all are through with this, shall we go to the next question now? Next question, students. So this is through. So now I'm going to the next question, students. Students, assessment part, I'm going to do it with this thing. I'm not touching assessment because then I have to connect the assessment procedure. So immediately after transfer pricing, we will be doing assessment procedure. So let's do first assessment procedure there, and then whatever are the assessment and some penalties provision which are there, I'll connect with this particular transfer pricing also. Okay. So right now I'm not touching it. So congratulations, students. We are done with this assessment. We are done with this one. The small question is there if you want. Let's do 472, students. At least let's do 472. Mr. Rakesh received a draft order from the assessing officer as per section 144C. Remember 144C DRP, Dispute Resolution Panel. So Mr. Rakesh received the draft order from the assessing officer as per 144C of the Income Tax Act 1961 due to the variation determined by the transfer pricing officer in the arm's length price. But Mr. Rakesh did not prefer to file the objection against the draft order before the DRP. Instead, he preferred to do appeal before the CIT appeals under section 246A. Against the final order received from the assessing officer. So he does not want to go to DRP. Students, he does not want to go to the DRP. Instead, he wants to go to whom? To the CIT appeals. You are required to advise Mr. Rakesh whether his contention are tenable. Whether his contention is tenable. Discuss the issue with reference to the provision of section 144C of the Income Tax Act 1961. Students, this question is trying to ask you that whether the recourse to DRP, is it mandatory? Whether the recourse to DRP, what they're trying to say is that, is it that I have to go to the DRP? Is that the remedy which is available to me in the case where there is a arm's length price made by the department which I don't agree upon? So is it that I have got only the remedy to, is it that I have got the remedy to go to DRP only? And the answer is no. DRP remedy, students, is only an optional remedy. Always keep that in mind. So students, if Mr. Rakesh, he doesn't want to go to DRP and instead he wants to file the normal appeal, let him go. Let him do that. Do you know what he needs to do only? What he needs to do, students? He only needs to keep quiet. Once he gets a draft order, keep quiet. Keep quiet for how many days? 30 days. Automatically, students, what will happen? This draft order will become a final order. Keep quiet for 30 days. That particular draft order will become the final order, and that final order, now you can file an appeal before the CIT appeals, and thereafter ITAT, High Court and Supreme Court. That is the recourse which is available. But if you want to go to the DRP against the draft order, then please go ahead and file your objection before the DRP. Put up your objection before the DRP. Based on your objection, and after giving you an opportunity of being heard, the DRP will then give the direction to whom? To the assessing officer. The DRP will then give the direction to the assessing officer, and thereafter, students, based on the direction given to the assessing officer, the AO will pass the order. And the order so passed, the final order so passed by the AO will then be challenged directly to the ITAT. The final order passed by the AO will directly be challenged to the ITAT. Why the order of the AO passed as per the direction of the DRP is challenged directly before the ITAT? You are bypassing the CIT appeal and directly going to the ITAT. Why you do so? The reason is very clear, students. The reason is very, very clear in this case. And what is the reason? You all are aware of this one, students, now. You all are aware of the reason, students. The reason in this particular case is... What is the reason, students? Quickly. So the reason, students, in this particular case is... Can you tell me the reason, students? Because the DRP consists of all the CITs. The DRP consists of all the CITs. That is the reason, students. And that exactly is the point. So here, if you see, students, what they are trying to suggest. The contention of the SSC is tenable. Once the draft order is received, the SSC may within 30 days intimate the AO of his acceptance or file the objection before the DRP. The AO shall pass the order if the SSC intimates its acceptance or no objections are received. I told you, keep quiet. Keep quiet for 30 days. And what happens? The draft order will become the final order. The draft order, students, will become the final order in this case. So now what is the mention? In the present case, Mr. Rakesh didn't put up the objection during the 30 days period, and consequently the AO passed the assessment order under 143. Since no recourse to the DRP is taken, the remedy against the AO order to file an appeal is available. It is pertinent to note that section 144C provides the eligible SSC with an option to file. This is an option, students, and the option does not become an obligation. And the option is not going to be an obligation. Okay. So this is only an optional scheme, students. With that, we are done with the transfer price, students. And now let's start with the assessment procedure, students. So students, now then, at 10:15 we'll be meeting up for assessment procedure, students. 10:15 students, we are meeting up for assessment procedure. Are you ready for this one? So take a break, students, of half an hour, and at 10:15 students will meet for assessment procedure. So therefore now students, 10:15 assessment procedure would be there. We'll start with that. Okay, let's meet at 10:15 then, students. Take care.